The senior leadership listened politely. They told her the idea was too risky, too speculative, too far outside the firm's core competence. The post-2008 regulatory environment was hostile to anything that sounded like disruption. Their compliance team would not approve it. Their distribution channels would not market it. The proposal was rejected. Wood, who had spent 36 years working her way up the corporate hierarchy of American asset management, made a decision in that meeting that would define the rest of her career. She would leave. She would launch the firm she had just been told she could not launch. She would do it without the AllianceBernstein name, without the AllianceBernstein distribution platform, and without any of the institutional protection that had defined her professional life until that moment. She was 58 years old. She had 3 children, a husband who was ill, and a track record that was respectable but not extraordinary. She had never run her own firm. In January 2014, Wood registered ARK Investment Management with the United States Securities and Exchange Commission. The acronym stood for Active Research Knowledge, and it was also a deliberate biblical reference for the devout Christian who had named it. The firm launched its first 4 exchange-traded funds in October 2014. The flagship product, the ARK Innovation ETF, ticker ARKK, gathered exactly $20 million in assets in its first 6 months. By 2017, the fund was up over 80% on the year, mostly because of a single position. Tesla, which Wood had bought aggressively when most of Wall Street considered the company a probable bankruptcy. By 2020, in the year of the COVID-19 pandemic, ARKK returned 152.8%, and Wood was named the best stock picker of the year by Bloomberg. ARK Invest's total assets grew from approximately $3 billion at the start of 2020 to a peak of approximately $60 billion by February 2021. By 2023, ARKK had given back almost all of those gains. Morningstar, in a much-discussed 2024 ranking, named the ARK Innovation ETF the 3rd largest wealth-destroying mutual fund of the previous decade, estimating that despite the fund's spectacular gains in 2020, the late-arriving capital that had piled in at the peak had collectively lost more than $7 billion by 2023. The story of Cathie Wood is the story of conviction-based investing carried to its logical extremes in both directions. It is also the story of what happens when retail investor flows, social media fame, a once-in-a-century macroeconomic environment, and an actual investment thesis converge in the same vehicle and then diverge. What you are about to hear is an honest accounting. Not a hagiography, not a takedown. An attempt to understand what she did, what she got right, what she got wrong, and what a retail trader watching from a distance can take from her record. Catherine Duddy was born on the 26th of November, 1955, in Los Angeles, California, the eldest child of Gerald and Mary Duddy, both Irish immigrants. Her father had served in the Irish Army before emigrating to the United States, where he joined the United States Air Force as a radar systems engineer. The family was working class, devout Catholic, and academically ambitious in the way that first-generation immigrant families often are. She attended Notre Dame Academy in West Los Angeles, an all-girls Catholic high school, graduating in 1974. From Notre Dame, she went to the University of Southern California, where she enrolled in the undergraduate economics program. At USC, she came under the influence of Arthur Laffer, the supply-side economist who would later achieve national fame as the architect of the Reagan tax cuts and the namesake of the Laffer curve. Laffer became Wood's mentor. Wood graduated from USC summa cum laude in 1981 with a Bachelor of Science in Finance and Economics. She had already, 4 years earlier, in 1977, started working as an assistant economist at the Capital Group, the Los Angeles-based investment management firm that managed the American Funds family of mutual funds. The job had come to her through Laffer's introduction. In 1980, Wood moved from Los Angeles to New York City to take a position at Jennison Associates. She would stay at Jennison for 18 years, eventually rising to chief economist, equity analyst, portfolio manager, and managing director. In the early 1980s, when the prevailing Wall Street view was that interest rates would continue rising and inflation would remain entrenched, Wood publicly debated the bond strategist Henry Kaufman, then the most famous interest rate forecaster on Wall Street, on the proposition that rates had peaked and would decline. Kaufman was, at that point, predicting continued tightening. Wood predicted the opposite. The 35-year bull market in bonds that began in 1981, the same one that defined Bill Gross's career at PIMCO, vindicated Wood's call. She was 25 years old. In 1998, after 18 years at Jennison, Wood left to co-found a hedge fund with the philanthropist and investment manager Lulu Wang. The fund was called Tupelo Capital Management. Tupelo grew to approximately $800 million in assets at its peak. The structure of the fund, in retrospect, was an early prototype of the strategy Wood would eventually launch at ARK. In 2001, Wood left Tupelo to join AllianceBernstein. AllianceBernstein offered her a larger platform, a $5 billion mandate, and the title of Chief Investment Officer of Global Thematic Strategies. She would spend 12 years at AllianceBernstein, building the thematic franchise into a substantial book of business and developing the disruptive innovation framework that would later become ARK's foundational thesis. The 2007 to 2009 financial crisis was, for Wood's AllianceBernstein performance, a period of significant underperformance. AllianceBernstein's senior leadership was unimpressed. Wood, who had been quietly developing a counter-proposal during the post-crisis years, brought her ETF idea to the firm's leadership in late 2013. The proposal was rejected. Wood resigned. In January 2014, she registered ARK Investment Management with the SEC and began raising the seed capital to launch 4 ETFs. She used a substantial portion of her own life savings as the seed money. Her husband Robert was suffering from a serious illness that would eventually take his life in 2018. She had 3 children. The decision was, by any reasonable measure, the riskiest financial choice she had ever made, and she was making it at 58. The trade that built ARK Invest into a household name was Tesla. Wood began buying the stock in 2014, when Tesla was trading at the equivalent of approximately $20 a share on a post-split basis. The company at that point had recently delivered the Model S, was operating at a substantial loss, and was the subject of an ongoing short-seller campaign that argued the company would either go bankrupt or be forced to issue dilutive equity that would crush the stock. Wood's thesis was different. She argued in research that ARK Invest published openly on its website that Tesla was not really a car company. It was a vertically integrated platform combining manufacturing, software, energy storage, and autonomous driving, with the structural potential to become the dominant player in a transportation industry that would inevitably electrify. ARK's published 5-year price targets for Tesla, which began at $400 per share in 2017 and were eventually raised to $4,500 per share, were widely mocked at the time. ARK Invest, in 2018, doubled its Tesla position. Wood, who had built the position to roughly 10% of ARK's portfolio by mid-2018, increased it to 15% over the following months. She published detailed research notes explaining the underlying mathematics of why the position was being increased rather than decreased. She gave interviews on financial television in which she defended the trade against host skepticism. She tweeted research updates publicly, breaking with every convention of institutional asset management discretion. The trade played out over the next 3 years as one of the most successful equity calls in modern asset management history. Tesla, on a split-adjusted basis, rose from approximately $20 when Wood began buying in 2014 to over $400 at its November 2021 peak. ARK's flagship fund, which held Tesla as its largest single position throughout the run, returned 152.8% in 2020 alone. Wood's emergence into mainstream financial fame in 2020 was the product of a coincidence between a genuine investment thesis and an extraordinary moment in American retail investor behavior. The COVID-19 pandemic, the federal stimulus checks, the Robinhood-driven democratization of brokerage, and the lockdown-induced surge in time spent online all combined in 2020 to create the largest retail investor mobilization in American financial history. Millions of new accounts were opened. Trillions of dollars of stimulus money flowed into the equity markets. Online communities formed around individual money managers in ways that had no precedent. Wood became the figure around whom the largest of those communities formed. ARK's published daily trade disclosures became required reading for the retail investor community that called itself the buy the dip generation. Her appearances on YouTube channels and Twitter gave her a direct line to retail investors that no firm of her size had ever cultivated. The flow of retail capital into ARK's funds during this period was extraordinary. ARKK, which had managed approximately $3 billion at the start of 2020, peaked at approximately $28 billion by February 2021. Total ARK assets across all funds peaked at approximately $60 billion in the same month. The flows were predominantly retail. Institutional allocators were largely absent. By March 2021, the rotation had begun. The 10-year Treasury yield, which had bottomed at approximately 0.5% in mid-2020, rose sharply through the first quarter of 2021, putting pressure on the long-duration growth equities that dominated ARKK's portfolio. By the time the Fed actually began raising rates in March 2022, ARKK had already lost over half its value from the February 2021 peak. By late 2022, the fund was down approximately 80% from peak. Many of the retail investors who had bought in during the late 2020 rally had collectively lost the majority of their investment. In 2024, Morningstar published its widely cited ranking of the 15 largest wealth-destroying mutual funds of the previous decade. ARKK was ranked number 3. The $7 billion wealth destruction figure reflects not the fund's underlying performance, but the dollar-weighted experience of the actual investor base, which was disproportionately weighted toward investors who bought near the February 2021 peak. This is a pattern common to all dramatic return funds. The late-arriving capital is always the largest. The late-arriving capital is always the most likely to sell at the bottom, and the dollar-weighted experience of the average investor is always worse than the time-weighted return of the fund itself. What does Cathie Wood teach a trader sitting at a screen today? 4 lessons in order of depth. The most important lesson is structural. Conviction-based investing requires the right vehicle for the right investor base, and the wrong vehicle can destroy the right thesis. Wood's underlying thesis about disruptive innovation was, in significant part, correct. The companies she identified in the mid-2010s have, over the subsequent decade, grown into some of the largest and most consequential public corporations in the world. What failed was the marriage between that long-cycle thesis and a daily liquidity ETF wrapper marketed to retail investors who were performance-chasing rather than holding through cycles. The retail trader's analog is the same. A trading thesis with a multi-month or multi-year horizon needs a structural setup that protects against the trader's own behavioral reactions to short-cycle volatility. Position sizing, stop-out discipline, account separation, the willingness to ignore daily price movements when the thesis is intact are not separate from the trade. They are part of the trade. A correct thesis executed without the right structure is approximately equal to a wrong thesis. The deeper lesson is timing related. The worst time to attract capital is at the peak of your visibility, and the discipline to refuse it is rare. ARK's assets grew from approximately $3 billion to approximately $60 billion in roughly 12 months across 2020 and early 2021. Most of that capital arrived from retail investors who had been watching the previous year's returns and buying into the narrative. The retail trader's analog is the same. When your strategy is producing its best returns and other people are asking how to copy it, the structural fact is that the strategy is more crowded than it has ever been. The easy money has already been made, and the discipline of refusing additional size, additional leverage, and additional positions you would not normally take is precisely what protects you from the regression that is statistically about to come. Easy money is always a warning, not an opportunity. The deeper lesson still is intellectual. Thematic conviction is a real edge, and so is the discipline to hold a position through the period in which it appears wrong. Wood's Tesla position from 2014 through November 2021 returned approximately 20 times the entry price. The position was wrong in the sense that it was substantially underwater for several extended periods over those 7 years. Most of Wall Street thought she was wrong. Real thematic edge requires holding the position through the period in which it appears wrong. The discipline to do that is rare. The investor who has it, when paired with a correct thesis, captures returns that are not available to anyone who is rebalancing on quarterly performance reviews. The investor who has it, paired with an incorrect thesis, simply loses money slowly. The art is in distinguishing which one you are looking at. The deepest lesson is moral. The obligation to think honestly about your investor base is part of the work. Wood's defenders argue correctly that she has been more transparent than almost any other asset manager of her generation. Her critics argue, also correctly, that the marketing message attached to that transparency contributed to the late-arriving flows that ultimately suffered the worst outcomes. Both things are true. The honest reading is that an asset management firm has obligations to its actual investor base that go beyond the obligation to deliver returns. It has an obligation to think carefully about who is buying the product, why they are buying it, what they think they are buying, and whether the structure of the offering matches their actual needs and time horizons. The retail trader operating with their own capital faces the same question one layer deeper. What story am I telling myself about what I am doing? And does that story match what I am actually doing? The discipline of asking the question honestly and revisiting it during the periods when the trade is working is itself a form of edge. Most traders do not ask it. That was Cathie Wood. This was episode 46 of The Greatest Traders. I'm your host. Thank you for listening.